All right, welcome back, everyone, to another episode of Paladin Financial Talk. I'm your host, Jack Ekholm, and joined here today by my colleague, Matt Bryant.
Thank you, Jack. Good to be here.
Awesome. Looking forward to today's discussion here in the new year. Today, we're continuing this month's theme of taxes as tax season is upon us. And we're touching on something that's likely impacted most of you out there, and that is the tax advice that you hear from friends, family, that you hear on social media that is actually wrong. So it could just be incomplete or kind of out of context. That's really common, but it could just be flat out wrong. And so we're here today to discuss some of those pieces of advice, add some additional context and some explanations, and point out some that, like I mentioned, are just scams or flat out wrong. So when you hear these things from friends or family or on social media, it might make you feel like you're missing out on opportunities. But remember that if you're acting without clarification and advice for your specific situation, you could be doing something wrong. It could result in an audit, which could lead to fines, penalties, even jail time for really serious stuff that we'll dig into today. So, as I mentioned, we're breaking down some of the most popular pieces of tax advice that you might be hearing out there. And there are four of them for our discussion today. So the four that we'll touch on, one are social media tax scams. We'll second talk about what it really means to deduct business expenses and a lot of the details and requirements there. That's a big gray area with lots of confusion. Third, the rules and risks around hiring your kids in your business. And then fourth, how earning income abroad works when you're mixing in different tax systems, the U.S., and then income earned abroad as well. So, Matt, would you care to kick us off? We'll start by talking about some tax scams.
We'll talk about tax scams. And as I launch into this, and most of our listeners are probably aware, our tax code in the United States is extremely complicated, very much influenced by special interests and whatnot. So it's understandable that people get confused, but then you get this misinformation surrounding it, and sometimes it sounds too good to be true, which I know we'll talk about here shortly. But as far as tax scams, so talking about tax protesters, where these are folks that think taxes are theft. We're going to talk specifically about Form W-4T and the W-4T scam. So we're all familiar with the Form W-4. It's when you're working, you fill it out, you submit it to your employer. This is where you can dictate how much of your paycheck gets withheld and sent to the IRS for federal taxes. Now, you're going to provide information like filing status, children, dependents. That's where you get your credits for the dependents. Then additional deductions that you can add instead of the standard deduction. Income you'll have from other jobs. So it's a way for you to try to essentially pay your taxes throughout the year rather than having them all due come April.
Right.
Now, one option that you can elect is exempt from withholding. So what this means is you don't expect to owe taxes, or you expect to owe very little in that year. So you don't want taxes to be withheld from your pay. That makes sense, because if you're having taxes withheld from your pay that you don't actually need to pay, well, then you're just giving the government a loan. So you'd rather keep that money in your pocket for ongoing expenses and whatnot. So that does not mean, though, you are exempt from paying taxes. If you elect no withholding and you end up owing taxes, you still have to pay your tax bill. Just because you elect a box that says, no, not gonna have any withheld from my paycheck, doesn't mean the government doesn't expect you to pay those taxes, right? So you need to be mindful of that. If you are not paying a certain amount of taxes as you go through the year, not only do you have to pay those taxes come April, but there could be an underpayment penalty on top of that. Now, why might someone not owe taxes? Well, for example, if your gross income is going to be less than your standard deduction and any other deductions that you get, well, you're not going to have to pay any taxes. Now, what scammers have done, they've created an alternate form that instead of the W-4, it's the W-4T. What they are doing is instructing people to download it, fill it out, and send it, not to the IRS, to your congressperson or the IRS directly, I guess. But it's parties that don't know exactly how to respond. So they're getting these forms and they're like, what's this about? Now, what they're suggesting is they're telling people that they don't legally have to pay taxes because they have this form W-4T. That's
Yep.
not the case. It's not a form that is real or official as far as the IRS goes. So if you come across this scam, don't think, oh, wait, look at this loophole. I'm out of paying taxes just because I found this other form on the internet.
Mm-hmm.
You're going to get in trouble. First of all, if you do that and you don't get caught for a number of years, well, you're going to get caught eventually and have to pay all those back taxes plus fines, plus likely more trouble beyond that. So
Sure.
if it sounds too good to be true, and this will come up again and again, probably is. So there is no document out there where you just simply submit it and say, nope, not paying taxes this year. I guess you could submit it and say, I'm not paying taxes, but it will catch up with you eventually. So that's an interesting one. It seems common sense that wouldn't actually work, but it's popular enough out there that we're able to talk about it.
Yeah, I've seen a number of videos on it, and what you'll see in those videos, and it's kind of a common theme with a lot of social media tax advice, where they make it seem like I've found this secret that nobody knows about. Here's the form, it's in my bio, go download it, send it off to this person, and you're good. And they seem trustworthy, and you think, oh my goodness, they're trying to keep this a secret because they don't want everyone to figure out about it. So again, seems too good to be true. It likely is, and it's the case here.
And it's like the best advice oftentimes isn't the most exciting. So you're not going to get a lot of clicks doing it that way, but you get a lot of clicks if you say, hey, look at me, don't pay any taxes. So just be mindful of that. Next one is Section 508C 1A scam. So this exempts churches from having to fill out the forms necessary to become a tax-exempt 501c3 organization. So there are people online selling a service where they will help you set up a tax-exempt church entity using this exemption, and then have the church entity own your business so that all your business income is tax-free. Now, this just seems right off the top obvious, but I'm sure there's, anybody's trying to cheat the tax man and trying to squeeze these through, but this is tax fraud, right? You can't do that. Obviously, this is too good to be true. Don't fall for scams advertising that they'll be able to make all your income tax free. We know that's not really a thing that exists. So you can interpret the tax code however you want, but that doesn't mean the tax courts will, right? The IRS and the tax courts are following the letter of the law. Just because your interpretation says one thing doesn't mean it's necessarily going to fly with how they do things. So the IRS does respond to these scams. Like, they're out there trying to make examples of some of these folks. So just be mindful that if you're browsing through the internet, browsing through social media, and you see something that sounds too good to be true, you definitely need to think twice about it. So there are a lot more scams beyond this, but these are two of the more popular ones. So shifting gears now, let's talk about business deductions. One of the common things that you hear, people want to set up small businesses, LLCs, or a small business owner, and they're like, well, if I do it through the business, then anything I buy is tax deductible. But as we know, that's not necessarily the case.
Yeah, and people take that to some far extremes. It's correct that in general, if it's an expense for the business, it's deductible from the business's income, and it makes sense, right? If your business makes $100,000 during the year, but you spent $40,000 to get that $100,000 in payroll and other costs, for example, you're only going to be taxed on the $60,000 net profit. Makes sense, but people take it to far extremes. So people can even rationalize and have in the past, well, I need good sleep to do my business, right? So if I'm a business owner, I could deduct the cost of my mattress, right? Or I need to be able to see to do my work. So I should be able to deduct the cost of my contacts or my eyeglasses, right? So they're taking it to an extreme, and it's important to remind yourself as a business owner of the requirements for an expense to be deductible for your business. So there's kind of three main prongs. The first is it has to be ordinary, and these are actual terms used in the tax code by the IRS. So ordinary meaning it's common and accepted in your specific line of work or your industry. So For example, a baker buying flour and sugar to produce the goods that they do within their business, that makes sense. That's common in their industry. A plumber, if they wanted to go out and buy a yacht and have that be a business expense, not ordinary for
Nope.
plumbers or in that industry. So wouldn't be ordinary, likely not going to be deductible as an expense for their business. Now, when we talk about things like yachts, it's important to remember it wouldn't be ordinary for the plumber's business and for most businesses, but it could be ordinary for another. If you own a yacht charter business, it's,
You're buying yachts.
it's probably you're spending money on things like a yacht to operate your business. So it could be in one industry and not in another. The second prong, so we talked about being ordinary. The second has to be necessary. So it doesn't mean indispensable, like absolutely necessary, but somehow helpful for your business. So necessary things would be like Matt, you and I, we work in an office. We would not be able to do our job if we didn't have internet in the office. We need to access the internet.
Correct.
We have shared file systems. We have softwares that we use. We need to be able to access those. If I'm operating a gym, I need to have an AED. It's required by law in a number of locations throughout the gym. So if I'm spending money on the internet or the AED, of course, that would be necessary. Helpful would be something like I'm a salesperson. I'm taking a client out to dinner, right? It's the part of the process of getting to know them and explaining my business and potentially generating more revenue for my business. So it's helpful to the business. Completely necessary? No, but at least somehow helpful. Examples of ones that wouldn't meet this criteria: if you are buying specialized equipment that your business doesn't need, or if you're paying for an office space that your business doesn't actually use or need, again, not going to be necessary, likely not going to be deductible. So we talked about ordinary and necessary. The third prong is reasonable. So this is one where I think people get it wrong very often because, hey, it's ordinary and it's necessary. It makes sense for my business. But again, they take it to an extreme where they're spending an excessive amount on the expense, more than a prudent person would or has to. So, for example, we talked about taking a client out for a dinner,
Right.
and that makes sense. You don't need to go to a luxury restaurant where you're spending $5,000 per person for that meal, though. Or if you're traveling for a business trip and you stay in a luxury hotel that costs 5 times the standard market rate for a hotel for the given city, those would be considered excessive, and only the amount in excess of what's reasonable, or rather any amounts in excess of what is reasonable, those aren't going to be deductible. So if you get audited, you're going to need to provide explanations as to, again, why these are ordinary and necessary and why the costs are reasonable for things like that. So overall, they have to be related to your business activity and with the intent to realize a profit or produce income. And again, they're reasonable, so not excessive. And people trying to, again, rationalize why a certain expense should be deductible, the tax courts have seen this before. It's the oldest trick in the book for small business owners. And interestingly enough, because of that, small business owners and self-employed people are among the most likely taxpayers to get audited, and especially when they show on their tax return large or otherwise unusual business expenses, because again, the IRS is going to be suspect about why you're needing to spend that amount of money to operate your business.
Yeah, absolutely. And it seems, and a lot of those things, there may not be guardrails when you're doing it. And you're like, oh, this absolutely is justifiable. And you may get away with it for a year, 2 years, 3 years. But then eventually when you get caught, all of a sudden, all your books are being opened up and they're going back years to look at it. Then you're in a really tough spot.
Yep. And that's another important piece here. Regardless of the expense, and on top of it, meeting those requirements, if you're going to be deducting it, you will always need proof of payment. So a bank statement or a credit card statement that shows it being paid from the business's account or credit card. So not from your own personal bank account, and now you're putting it on the business's tax return. And then also a receipt. So showing what you actually bought. Can't just be, sort of this ominous number deducted from your bank account without proof of you actually purchasing something and then having an explanation as to what that is. And another piece here, if you end up getting audited as a business owner, the IRS has the internet too. They can look at your website, they'll look at your social media, they'll look at your products that you're offering to see if this expense that you're claiming as a deduction make sense for what your business actually does. So if I just open a YouTube channel to say I have a YouTube channel, but I'm not posting anything, they're going to be able to see that, for example. And again, they can see through all of it.
Yeah. And I imagine being organized, if the IRS is knocking on your door and just handing them a shoebox full of receipts probably isn't going to fly. And
Right.
so you need to make sure your I's are dotted and T's are crossed as far as that goes.
Yep. Good way to put it, I think, is as a business owner, great power comes great responsibility, right? This opens flexibility for a lot of additional deductions. But you have the responsibility to be very meticulous in your record keeping and keeping documentation to make sure that you're doing things correctly and have proof and justification as to why certain things are deductible. So another thing I wanted to mention, kind of explain here, is let's say you're making a major cash outlay in your business and you're buying a piece of equipment or some asset that you're going to use within your business. Something to keep in mind, you may not be able to actually deduct the whole cost of what you're purchasing right away. So if you have these capital expenditures, there's 3 main methods that you can use to actually deduct it from your business income. So generally, things fall into different class lives based on what the IRS prescribes. And the IRS also has certain depreciation schedules for assets that fall within each class life. So there's 3, 5, 7, 10, 15, and 20-year class life assets. And depending on where they fall, the IRS will allow you to deduct the cost of what you spent on it over that number of years. So if it's a 5-year asset, it's over 5 years. And they have what's called the Modified Accelerated Cost Recovery System. We call it MACRS, where they give you a specific percentage of the cost that you get to deduct each year. So there's that system. Now, keep in mind, for real estate, they operate under, real estate assets operate in a different system. So residential rental property, that's going to be depreciated over 27.5 years. And non-residential, so like an office building, for example, that would be 39 years. So instead of getting that whole deduction up front, which you're probably looking for when you're making a big purchase, the IRS is saying we're going to make you depreciate that and get that deduction slowly over time, as long as for non-residential real estate, 39 years. Now, there are other opportunities for you to push up that depreciation and that deduction into the current year. So they have what's called Section 179. So a business owner can immediately expense up to $2.5 million, and it's just higher than that this year in 2026 for assets that you placed in service during that year. Now, the caveat here is whatever you're taking a deduction for has to be used more than 50% of the time in your business, and then it's only deductible to the extent that you're using it in the business. Right. So if I'm buying $1 million piece of equipment and I only use it 50% of the time in my business, I'm only going to get $500,000 of that as the deduction. And a note here on the Section 179, depreciation or deduction, it can't create a business loss. So if I'm thinking, hey, I have this income outside of my business, I'm going to make this big expenditure and get this big deduction, and then I can offset my other source of income, the 179 deduction can't create a loss within your business. So it's limited to the income from your business. So it's capped there. And then these two that I'm going to talk about, to the 179, and then also what's called bonus depreciation, those aren't applicable to real estate. So neither of those opportunities are going to allow you to push up the cost of real estate, whether residential or non-residential, into the current year. Again, you're following that 27.5 or 39-year schedule. And then beyond Section 179, after that, if you decide not to use the MACRS schedule, you want to push it up further, maybe you cap out the Section 179 deduction. There's also what's called bonus depreciation, where you can deduct the full cost in the current year. So again, same thing applies here. It has to be used at least 50% of the time in the business, and then only deductible to the extent you use it in the business. But the benefits here with bonus depreciation, there's no cap, there's no phase out, and it actually can create a loss within your business. So it could exceed the income you have from your business. Now, formerly, it was only allowed for you to deduct through the bonus depreciation 40% of the cost. The One Big Beautiful Bill Act, as of July of 2025, has pushed that permanently to 100%. So that's lots of benefits there for small business owners. Now, keep in mind here, it's very appealing to push up deductions into the current year and eliminate a lot of income. But keep in mind, if you're taking that deduction now, you're not going to be able to get that in the future. So if you're part of a growing business with income that's increasing each year, it might actually make sense for you to follow those depreciation schedules and be getting a piece of that deduction each year over time.
Especially if your income's increasing. Absolutely.
Yeah. One really common misconception here comes up around cars, Matt. So business owners wanting to buy a car through their business. And of course, there are similarly lots of rules and requirements there. What should people know about that?
Yeah, this is I think one that's fairly popular. So common problem area, the IRS is privy to all this, right? Common business maneuvers, and they're going to impose limitations on this. They don't want people trying to fully deduct $150,000 truck or car purchases,
Right.
Especially if it's not perhaps being used entirely for that particular business. So the amount that you can actually deduct depends on the percentage used for business purposes. So you mentioned that up above. Same with vehicles. Now, one of the things kind of obvious, but you can't conduct that or deduct that the family road trip, right? Just because this vehicle is used primarily for business doesn't mean you can take a 3,000-mile road trip and somehow deduct all of it. So commuting to and from the office doesn't count. Even if you conduct business activities like making a work call along the way. So that would be handy if you could drive 30 miles to work, make one phone call and deduct the entire trip. It doesn't work that way. It does include things like driving from the office to a client's home, for example. So we work with a lot of individuals and small business owners. So maybe driving to their place of employment or their home if we're doing meetings there. Between work locations, if we had multiple locations, that would be a place to do. Now imagine, someone who works in real estate or a business owner with multiple factories or whatever it may be. That's a different story. Or running work-related errands during the day. So you're not driving to and from home, but the things that are centered around the office, that's where it comes into play. Now, record keeping, again, going back to earlier, you need to be diligent with how you keep your records, because if the IRS does come knocking, you need to make sure you can prove all these claims that you're making. So be meticulous with mileage, logging, how many miles you're claiming, the dates you're doing it, your starting point, your end point, why you're doing it, time spent doing it. All these things are going to be helpful if you come to be audited. Now, deduction methods, two primary ones, standard mileage rate or actual expense method, which is a percentage of the car being used for business. Also, the Section 179 that you talked about up above. So standard mileage, I think this year it's about 70 cents a mile. So you can deduct that. The percentage would be, hey, I have this car. I'm a small business owner. I'm going to use it for personal reasons as well. Like I can't afford to have 3 or 4 cars. I had this vehicle. Half of the time I'm using it for my job. Half the time I'm using it to haul kids around to whatever. So you can't deduct going to soccer practice, but you can deduct it for the reasons I mentioned above. So that would be deducting a percentage of the vehicle rather than the whole thing. That's key to know because that's pretty obvious. You're going to get in trouble if you try to deduct a whole thing. Now, cars under 6,000 pounds are considered listed property. So suspect the IRS because they can easily be used for both business and personal. And the depreciation you can take is really pretty limited. So I drive a pickup truck, and when we were doing this, I decided to see how much it weighed. I never looked that up before. It's a full-size pickup truck, weighs 5,000 pounds, right? So I think it's a big truck, but it falls under that 6,000 pound for a reason. I'm not out there doing contracting work with my pickup truck, right? You need a bigger vehicle to be able to do that. And that's why they put that in there. In 2025, first year deduction with bonus depreciation was limited to $20,200 and then lower amounts in each following year. And there's luxury auto limits as well, right? They don't, again, want you buying hundreds of $1,000s worth of truck and trying to deduct it all. Now, people try to get over the 6,000 pound by buying a luxury SUV. Well, there's a limitation for cars between 6 and 14. So the max section 179 deduction in 25 was 31,300. So all kinds of moving parts as far as this goes.
Yeah.
You can't just simply go to the luxury lot and say, hey, I want that car because that's the best one out here, and expect to be able to deduct the whole thing. There's going to be a lot of rules that go along with how you do this.
Yep.
Now, you could deduct the rest in the first year through the bonus depreciation, but only get to deduct, again, going back to what I said earlier, the percent used for business, and it has to be at least 50%, right?
Yeah.
So those are key parts. I don't know if you drive around and see a lot of, Denali pickup trucks and whatnot out there in the service industry, but it makes sense to be able to deduct that because you're probably spending a lot of time in your truck or your car if you are using it truly for business reasons. So you should be able to deduct it, but just be careful and don't expect to be writing off family vacations and whatnot. So as far as like what you talked about and then what I talked about with the vehicles, small business related, it's complicated. And
Very
there's
complicated.
a lot of opportunity to save money as far as taxes go. But there's a lot of money or a lot of opportunity to get in trouble too. Even if you have the best intentions at heart, there's still so much that's convoluted about this that you have to work with a professional to get this right.
Absolutely. And going back to the car piece too, like you mentioned, your full size pickup is under 6,000. Most passenger cars that you buy that are going to be for both personal and business use are going to fall under that. So if you're buying a $300,000 G-Wagon, that's 50% for personal and 50% for business. Again, you're only going to be able to deduct 50%. And it's probably going to take you 30 years to get the full deduction because of those weight limitations.
Yep.
So be aware of all of that. Another thing to be aware of, and I saw some videos online about this where, I could start a YouTube channel where I talk about Rolexes and luxury watches, and then I can buy through the business luxury watches and keep them as inventory. So that could work, but something to keep in mind here, if you're taking a deduction for something, that reduces your tax basis in it. So if I spend $10,000 on a watch, but I deduct the $10,000, my tax basis in it is zero, right? Because I haven't paid taxes on any of the money that I spent on it. So if I'm trying to later turn around and then sell that watch, it's going to be taxable any amount that I get for that watch. Again, if I have no tax basis in it. So consider, you have to weigh current year benefits versus future year implications for a lot of these decisions. And as saying that my CFP professor mentioned that I didn't know was actually a popular saying, but don't let the tax tail wag the dog. And basically what that's saying is don't make decisions just based on minimizing your tax burden. You have to look at the decisions holistically. So we talked about buying a $300,000 luxury car. Even if you could get a full deduction for that, which again, you might not be able to, and it's going to take many years to do that. Does it make sense in the first place to be buying a $300,000 luxury car?
Right.
And for a lot of people, it doesn't. So it's important to consider the tax implications. Yes, there are benefits there, but you have to consider those decisions holistically as well.
And we hear the tax tail wagging the dog as far as investments go a lot, where someone has stock, for example, that's highly appreciated, but maybe half of their investable assets are invested in this one company, and they're just terrified to sell any of it because they'll have to pay taxes. Well, the other side of that coin is if you don't rebalance or properly manage your portfolio, looking at where are the best places to invest, and you just let that stock ride and it's not the best place to be, well, the market's going to take you down,
right?
Versus having paid taxes and then investing in something that might be better. So that you can't be afraid of paying taxes. Generally, it means is you've made money in some capacity. It's just you want to be prudent about it.
Right. And we could look at that situation, somebody with highly appreciated stock, and say, I could find a way for you to pay no taxes on it. Just give it to charity. And it's deduction. Okay, you've saved taxes by doing that, but you've also given away all of the stock.
Right.
So there's a cost to getting those deductions. And people go crazy for deductions and write-offs. Just remember, they're not a dollar for dollar reduction in your tax liability. They're reducing the amount of income that's taxable to you. So if you have a 25% marginal tax rate, each dollar you earn is taxed at 25%. If you have a $10,000 deduction, you're saving $2,500 in taxes, but you spent $10,000 to get that deduction, right? So there's still a cost there. If it's an expense you're going to make anyway, great that you get a deduction for it, but does it make sense to be making purchases and, expending money just for the sake of a deduction? In most cases, no.
No, and it's different than a credit. A credit is very valuable because that reduces the tax that you owe versus a deduction, which reduces your income. You you need to be mindful of that. And again, don't go overboard because you get this fancy deduction, because at the end of the day, you may wind up paying more than you would have otherwise. So just be responsible as far as that goes. So here's one that we hear a lot. So small business owner, maybe a family run business. I'll just hire my kid as an employee of my business, put their picture in some of our presentations on the website, call them a model, and pay them just enough so they don't have to pay taxes on any of it. And then I get a deduction for paying them. Hiring your child is legal, but the IRS is really going to take a close look at this, because this is what's called a related party transaction. You and your child had the same economic incentives, right? Child's probably living in your house. You're both kind of rowing the boat in the same direction, so you're incentivized the same way. This is different than a traditional employee-employer relationship. To put it bluntly, the employee is trying to make as much money as possible for the work they do. The employer is trying to get that work for as cheap as possible and paying that employee as little as possible. So that, obviously they want the business to succeed, but that's different than the parent-child relationship where it's related party transactions. So again, extra scrutiny there, because that's a loophole people think they've discovered where they can maximize, basically moving money from the right pocket, putting the left, because it's your kid and you're still in charge of it, but claiming a deduction along the way. So not going to work if you don't do it properly. Now, requirements you will be held to: the work has to be legitimate and necessary for the business. So filing, scanning, doing data entry, probably things that aren't overly technical, right? But things that do help the business and save the rest of us time. Can't be personal chores. You can't say, hey, go mow the lawn, and I'm going to call that a business expense. Now, the wages must be reasonable and commensurate with the market rates for the work they're doing. You can't be paying your kid $100 an hour to scan files, right? That's not going to work. Now, you also have proper documentation. If you're doing this, you are making them an employee, so you can't just hand them cash and then try to claim it down the road. You need to do the proper documentation, I-9s, W-4s, an actual job description, records of time worked, punch cards, all those good things, so that come end of year, when you are filing your taxes and you paid your kid X amount of dollars, it's easily justifiable what they were doing and that they were compensated appropriately, not something extravagant for not doing any work other than being your kid.
Right. That's a good point. We talked about business expenses in general and the requirements of those. Remember, paying somebody through your business as an employee, it's also a business expense. So similar to how anything you buy in your business that you plan to deduct needs to be ordinary and necessary and reasonable, it's the same thing if you're hiring labor and paying them. So if you're going to hire your kid for something in your business, it has to be something that's ordinary, that's necessary in your business, and you're paying them a reasonable amount. So keep all of those things in mind. I also saw a number of videos when we were looking into, different pieces of tax advice online about opportunities to reduce your income by moving to or earning income in other countries. You may have heard of other countries that have very different tax systems, very, in often cases, lower taxes than the United States. So like United Arab Emirates, for example, Dubai and Abu Dhabi cities, we know, no personal income tax, no capital gains tax. In Monaco, there's no income tax. In the Bahamas, there's no income or capital gains tax. Lots of countries out there that do taxes and generate revenue for their governments a lot differently. But it's important to remember, as long as you're a U.S. citizen, you're going to have to report and pay taxes to the US on all of your worldwide income. So that's income earned in the US and anywhere else, regardless of where you live or where it's earned. So wages, self-employment, interest, dividends, rental income, all of that. You're reporting it on your US return in US dollars. And like I said, that's going to apply as long as you're a US citizen. So yes, you can get the benefits of these other tax codes, but you're going to have to renounce your US citizenship to do that.
Kind of a big decision.
And it's a huge decision. It's irrevocable. And once you do that, you're unable to return to the country in most cases without having a visa, just like a US citizen traveling to another foreign country. So don't, again, like we talked about, not letting the tax tail wag the dog. If you're going to renounce your US citizenship just to save money on some taxes, make sure that that's a more holistic decision that you're making.
And I think what we're seeing is the wild things that people will do to try to save a few $1,000s on taxes. To me, it seems like more work in the end than just paying your share, but I digress.
Yeah. And now there are some opportunities and some things in the US code to prevent double taxation on income that you're earning in another country being taxed in that country and also in the US. The US has what's called the foreign earned income exclusion. So in 2026, up to 133,000 roughly of income that you earn from services that you're performing in other countries, you can exclude from your US gross income. So that's a good amount, but there are requirements for you to be eligible for that. You either need to pass the bona fide residence test, where you actually have a permanent tax home in the other country for purposes of employment, and you're a bona fide resident in that other country for the entire taxable year, and you intend to work there indefinitely. So that's going to be pretty hard to meet. It's not just moving to another country for 3 months and working there for 3 months, and now you're going to be able to exclude the income that you earn there. You have to be there the whole year. And then the other test that you could potentially pass is the physical presence test. So you don't necessarily have a permanent quarters there, but you're actually in the country for at least 330 days of the year. So again, more than just the 3 months or whatever short period where you're going there temporarily to earn some income there. And then there's also the foreign tax credit. If you are paying taxes to another country's government, some or all of those taxes you will get a credit for from your US income taxes. But what's key here is it's limited to the portion of US taxes that's attributable to that foreign source income. So if they're taxing you at 10% in the other country, only 10% of the US taxes that you owe are you going to get a credit for. So it could be substantially limited if you have a lot of income in the US, but also income from another country. So,
and when the course of researching for all this, I read a few stories about, well, with COVID, it became popular to work fully remote, right? And a lot of companies for a lot of years, and some still do, allowed people to say, look, if you have an internet connection and you can be available during these hours here in the US or whatever it may be, then, feel free to work from wherever, with the thought being working from wherever in the United States. Read some articles where people were taking up residence in other countries, and eventually their boss found out, and that led to disciplinary actions or maybe termination, because it's not just what you described here about where do you pay taxes. Well, these countries or these companies, if they're based in the US and they have all US employees, all of a sudden have international employees. Well, that changes how they have to file taxes as well. So you may think, oh, it's no big deal. I'll just go post up in this other country and I'm going to log in for my 8 hours and get my work done. Well, that's not the same thing as, doing it from home in the US or even a vacation spot in the US. So there's a lot that goes into this because our tax code is so complicated. There's benefits in here, absolutely, but talk to an expert if you're going to be making some of these big decisions. So
get some clarification before you make a big decision.
So we talked about a lot today, the social media tax scams to avoid falling victim to. Who knew that you couldn't trust everything on the internet, especially TikTok, but be mindful of those rules and responsibilities to be aware of related to deducting business expenses. You went into a lot of great detail as far as business expenses go, a lot of detail I think the point that people should take from that is it's complicated. There's a lot of opportunities there, but you need to work with a financial advisor and a tax advisor to make sure you're getting your maximum benefit without stepping over the line and getting yourself into hot water. Third thing was what to be aware of when considering hiring a family member in the business. And then last, how foreign income interacts with U.S. and foreign taxes and tax systems as a United States citizen. So a lot of good information throughout. So as we wrap up, the big takeaway is this: when it comes to taxes, advice without context is dangerous. What works for one person or is generated to create a lot of clicks may not apply to your situation at all. And don't try to force a round peg into a square hole, so to speak. Before acting on any tax strategy, it's important to understand the rules, the trade-offs, and whether it actually fits your financial picture. So that's why professionals exist. Don't hesitate to reach out to us here at Paladin Financial for all things financial, and we can help find a tax professional for you and work it into your plan. We'll be your quarterback as far as that goes. We do have Paladin Tax Services that we started recently. So that's a place where we can actually help with tax prep. And also there's some tax planning that goes along with it, especially for small business owners. If you have any interest in that, you can email info@paladinfinancial.com. That's info@paladinfinancial.com. Obviously, we have a phone line. You can call 651-842-8406, 651-842-8406. We'll have that conversation with you, get the ball rolling there. PaladinFinancial.com. We have some resources there. You can also request a consultation through the website. Follow us on social media, rate our podcast. We put a lot of time and effort into these, and we've had a lot of good feedback from people so far. So we appreciate you listening. We appreciate you watching. If you're viewing us on YouTube, Jack, thanks for all the work today. It's been good working with you on this podcast. It's been a great
conversation.
And that's it for another episode of Paladin Financial Talk. Thank you.
Thank you.